A subscriber asked me a great question. Can you build a FIRE portfolio using GPIQ, GPIX, SCHD, and then maybe throw in a little SCHG and SPMO without relying heavily on return of capital heavy income funds like QQI or SPYI? I love this question because it addresses a challenge many investors face. They want income, they want growth, they want financial independence, but they don't want a portfolio built entirely on covered call and option income funds. So today I'm building 3 portfolios using these exact 5 ETFs. A conservative FIRE portfolio, a moderate FIRE portfolio, and an aggressive FIRE portfolio. Then we'll compare income, growth, total return potential, and retirement sustainability. We're going to look at both the Simply Money Portfolio Planner and the Simply Money Retirement Template. So stay tuned. Welcome back to Simply Money. Today's video comes directly from a subscriber request. We're taking 5 ETFs, GPIQ, GPIX, SCHD, SCHG, and SPMO, and building 3 different FIRE portfolios. The goal isn't to find the highest yield. The goal isn't to maximize growth. The goal is to find the balance between generating income today while still allowing the portfolio to grow enough to support decades of financial independence. Let's start by looking at the Simply Money Portfolio Planner. We're going to look at the 3 different scenarios. If you've never seen this before, this is a great worksheet where you can do different scenarios, allocating to different funds, comparing them, doing deposits and withdrawals, whether you're growing your funds or taking your funds. You can set all sorts of different parameters and see how it would forecast. We have different return modes you can choose from. Lots of different options on here. This and the retirement template are both available on the Simply Money Buy Me a Coffee link in the description below. So starting out, we're going to be looking at the conservative with 20% in both the GPIQ and GPIX, 50% into SCHD, and then we have 5% of growth for SCHG and SPMO. You can change these if you want to go different allocations on any of these. This is just how I'm setting it up. The subscriber just basically asked me to use these 5 funds. Didn't give me an amount, like how much is the portfolio valued at to begin with. So we'll play around with some different numbers, but that's a wonderful thing on this sheet. You can do all that yourself. Now we've set the return mode to the manual 50th because I want to project forward what we assume, and again, we're assuming what these funds should do in the next 10, 20, and 30 years. If we knew, we would all be very, very wealthy, but none of us know, so we can only go off historical data, what we think they'll continue to do, and then obviously you have to be flexible to make some adjustments if things aren't going the way we plan. I'm going to start, don't yell at me yet, I'm going to start with $550,000. I know not everyone has that amount, but I wanted to start there, and we'll actually work down from there and look at how it survives in different portfolio balances and as well as these different conservative, moderate, and aggressive allocations. Before we get started, remember this is not financial advice. This is for informational and educational purposes only. All investments come with risk. Please do your own due diligence. Okay, let's dive into the conservative mode. We have no deposits because we're going to be in FIRE. We're living off of this. Our withdrawal rule is we're taking $4,000 out a month. If you're FIRE, I don't know what your income needs are. It could be way higher. It could be way lower. And your portfolio could be much lower or higher as well. So we're just going off this. I can't do every single scenario. Please send your requests, your submissions, and I'll do those scenarios as they come in. And of course, you're welcome to get this sheet so you can run it yourself. We're going to start that in month 1. We're going to do that for 30 years to see how it sustains, and we have inflation kicked on here, taking $4,000 a month. Okay, so as we come over here to the conservative model, you can see we have our allocations, and we're going to come into the forecast. Make sure your model right here is on conservative, because that's the one we're looking at. And you can see your portfolio on the forecast but it does not show you the individual funds. So we're going over to the Forecast Pro, and this breaks it down. You have GPIQ, GPIX, SCHD. It shows you your allocations, and then it shows you your portfolio total over here, the income generated, and your income paid, and then you're taking it out of Fund 1, 2, and 3, 40% and 20%. That's just how I have it set up. You can set it up however you want, but this is how we're running this scenario. And you can see as we come down to the end of 30 years, you can see that we've done well. All funds are still positive. But again, this is linear. This is not real life up and down. That's where the retirement template will show us the various scenarios of how this will pan out. Don't get too excited on this. This just helps us to see how the allocations work together and what percentage is going on in each one. But this is just the conservative. I want to switch back over here. You can see the moderate, we're at 25. We reduce SCHD, and then we increase the growth. So we'll come to forecast. We'll switch this to moderate. See if this does better with that allocation. So you can see what your allocation is there. Now, just look at that. We'll come over to the total, and you can break it down. It's showing that you're going to grow your portfolio. Now, we can increase our withdrawals because you're going to want to increase that each and every month. We're just keeping our withdrawals flat right now, but I want you to see the difference between the moderate and the conservative. We go back to conservative, moderate did much better. Now we're going to switch it to the aggressive. Just to remind you, the aggressive is much more GPIQ and GPIX. You're income focused. Still have a little bit of dividend growth with SCHD. And then you have just a small bit, again, 5% in your two growth funds. Come back over here, you can see that has done very well. And you can see that GPIQ's done well. Now, I want to show you the portfolio planner so you can see how you can set up and compare various funds. But here's the thing I want you to look at. We're going to start with the conservative. Again, we have $550,000. Our average yield is 4.8 and our average appreciation is 8.5. If you come to the Simply Money retirement template, you put in your starting balance is the 550. We need 4,000 a month, which is 48,000. We're going with an 8.5% annual return rate. This is just showing 9 here. It's rounding up. You can see it up here, but it's still calculating 8.5. If you move the decimal over, it'll just show it. Don't get concerned with that. We're having our inflation rate at 3%. We're running this for 40 years. We're adjusting our withdrawals to inflation. We have our dividend yield at 5%, but again, that's set at 4.8. It's just rounding up. We have our dividend CAGR we're going to set that at 4%. We're going to reduce that down a little bit. Now, we have Social Security in here starting at age 62, and we have a second person at age 62. And you can switch these around, but I want to put some real life scenarios in. If you're a couple, that's very conservative amounts for Social Security. And I have the retirement age FIRE at 45. Again, I don't know, the subscriber didn't say, can you do it from 35 or 50? So I picked 45 to run this scenario. We're going to do an investment risk level of balance. We're not growth. We're not aggressive. I wouldn't call this super conservative. We're just going with a balanced for the model that we're going to run here. And a balance is moderate risk and balanced growth potential. Now for this, you come to the retirement confidence dashboard and you hit this run new stress test. It's running the numbers and it shows you your stress test is excellent. You get 100% confidence score. Your conservative outcome, you end with almost $2 million. Now, again, that's 40 years down the road. And what it did was, if you come over here to the Simply Money retirement stress test, it's simulated 500 times. You can see them all down column A. This is the simulation. And this shows you year 1, year 2, year 3, going across what the return was for that year. Now, the numbers we put in on the planner back over here, these numbers, it is averaging that. Each year, that yield and that return is averaged. Over 40 years, that's what the average is on all 500 simulations. But it does different sequences of return because that's real life. And by doing that, none of them failed. Not a single one on this scenario. Now, what I want to do is, because a lot of people are like, well, I don't have $550,000. And remember, we're putting the numbers in from this other the portfolio planner off the conservative allocation. The 20% in these, 50% in SCHD, and that's what the average yield is and what the average appreciation is. And that's what we're putting in over here. If we could go ahead and do the same for the moderate and for the aggressive and see what that runs if we increase the yield and change that based on the allocation. But what I want to do now is I want to say, okay, let's say we only have 400,000. What's that going to look like? We still need 4,000 a month. Let's run that. We come back over here to retirement score. Nothing else has changed. We just have $150,000 less. That lets you know, okay, that's a little bit scary. You start running out of money at 55. The median age you run out of money is 63. If the conservative outcome happens, the 10th percentile, you'd run out of money really quick. If you get the 50th percentile, you'd be looking at like 75. So it could be very scary. Again, let's go back to 550,000 for those wondering. Not 5.5 million. And let's say we need 5,000 a month. We have the 550,000. And we need $60,000, $5,000 a month, and we run that. So we increase the amount we need, but we have the 550,000. So now this is looking okay. There's some concern there. But that's where, if you're in fire, you're definitely going to have to be flexible. You're a little bit elevated risk, and you can come over here and look in all these different settings and play around with that. Maybe we go with a conservative return, that it's a lower risk and it's a smaller market swing. Maybe we run that and see what happens. And then that does a little bit better. So this gives you the opportunity to play with these numbers with the portfolio planner. You can set your allocations up and see what kind of returns you can expect depending on the mode you use. If you want to use historical data, if you want to use categorical, or if you want to use what does each fund predict it should be in the future. It's hard to predict. People forecast the next year or the next 5 years, and they're wrong most of the time. They might be in a ballpark, which is normal, especially in certain sectors, but oftentimes the predictions are way off because nobody knows. So we're using averages and standardized forecasting tools to do this, just to give us opportunity to run different scenarios to stress test. If we're going to retire or do fire, we want to stress test it. We want to see what's the best case scenario, what's the normal average scenario, what's the worst case scenario. What if I have 400,000? What if I have 300,000? What if I need 5,000 a month or 4,000 a month? You can run all the different scenarios. You can change your allocation. Okay, maybe I'll put more in growth, or maybe I'll add a fund. Maybe I don't want return of capital, but maybe I'll put one fund like QQQI in there or something else. And you can play around with these and see how different things forecast them to produce and to perform in the future. And then over here, this is where you can really get that forecasting of how will it sustain in retirement. If I need to increase my Social Security or maybe the age I retire, we could go with a growth investment risk level. It's higher growth potential with larger market swings. Again, you come over here, run the stress test. It's a little bit more aggressive. How does it do? It does a little bit more elevated risk than if you're in a more conservative portfolio. Now, the portfolio we're running, I would consider very balanced or conservative. If you look back here, this allocation would be conservative. You're only looking at 4.8% yield is very conservative. I've seen people run aggressive portfolios pulling 12, 13% yield and running these forecasts. That is very aggressive. And on the retirement planner, you would want that on very aggressive because it has to consider when it's running these scenarios, you have to have that swing. If you're in very aggressive funds, you have to run it with very aggressive swings. SCHD, if I had 100% SCHD, I would put that as a very conservative portfolio, and my swings wouldn't be as high. I wouldn't see as much growth, but I wouldn't see as many dips. Like here on this portfolio, even on balance, you're seeing right here, look at that, negative 21, negative 23% swings. If we swing this over to aggressive and run this again, takes a minute, be patient, and then you come over here, look at that, you have a negative 40% return, a negative 32% return. So the swings are much higher, but look at that, you have a 60% positive return where you wouldn't get that on a conservative model, because if you're in SCHD, you're not going to see a 60% growth year, most likely. In my opinion, 99% sure I would feel confident in saying that. But say you're in something like super semiconductor ETF like SOXX, you might see a 60% year return, but you may also see a 50% drawdown too. So that's where this modeling comes in, the risk level, and you should really do that on different levels just to see. Even if you have a conservative portfolio, test it against the balance, test it against the growth, just to get a feel of what different swings in the market could do. Again, that would make a worst case scenario, but in my opinion, it's nice to know if I have a conservative portfolio and it does fantastic on the stress test, and then I test it against aggressive market swings and it still does well, I feel pretty confident in that. So it just gives you opportunity to test different things. That is the portfolio. Thank you for the suggestion. If you want to see something like this, go ahead and leave me some information. The more information you give, the more I can run it to your liking. And I try to do as many of these as possible. If you just give me some funds, and I'll do different numbers with those as well, if you don't have anything in particular that you're thinking of. But thank you for that share. Leave me the comments on this. What are your thoughts on this? What would you do differently? I appreciate your input. Don't forget to hit that like and subscribe button. We'll see you next time on Simply Money.